Welcome back everyone to yet another video, and oh my god, Palantir's Q2 earnings were something else. And today we're going to be going through it all. As usual, whenever Palantir posts earnings, a lot of charts, a lot of data, and to be honest, without glazing, without being overly bullish, sometimes you guys even call me a Palantir bear, this might be the best software earnings results that I've seen. The only company that I can think of that surpasses this quarter is Nvidia. Outside of that, like especially in the SaaS space, Palantir truly delivered something special, and I will tell you why that is. So let's jump right into the Excel sheet as always. First of all, let's have a look. What you might notice is, of course, the markets have not yet opened for today, so we don't have an updated graph. However, we have a new fair intrinsic value here. Now, for those of you that have been following my channel, you know that the previous fair intrinsic value was $75 per share. It is now revalued and up to $124 per share fair value for me. And that is about a 65% increase just from one quarter. So, people ask me, why don't you sell your shares when Palantir is so overvalued according to you? Well, because for each passing quarter, the fair intrinsic value just increases, substantially every single time. As we learn more about the business, as they keep outperforming our expectations, the fair intrinsic value keeps going up. And that is why I'm not touching any Palantir shares, even if it appears to be extremely overvalued. Now, pricing wise, of course, it's still very expensive. Now, 533 price to earnings. Does it matter if it's 400, 500 or 600 at this point? Not really. I never care about pricing. I only care about fair value. And for you guys that are subscribers to my Substack, or if you have bought the Excel sheet that we'll be looking at today, you will be able to find my whole valuation model for Palantir. Now, let's get straight into the chart. We're going to go through category by category. I've been updating this, to the best of my ability. We don't have the 10Q yet. Typically, Palantir needs 1 to 2 weeks. So if you have purchased the, Excel data sheet that we're looking at here, that has like all the Palantir data you could ever want, the charting tool and stuff, you can expect an update as soon as the 10Q filing drops. So typically that's 1 to 2 weeks from now, because Palantir usually is very, very slow on those. Total revenue growth, 48%. We hit that $1 billion first and foremost. Surprised a lot of people. Surprised me. I thought that it was like a 50-50. That's what I said on the live streams yesterday. That's what I said during Palantir Weekly. But seeing that hit, I think caught a lot of people off guard. The increased guidance, of course, also very impressive. But we'll mainly be talking about the actual results. So first of all the revenue results, up 48% in total revenue. However, if we look at organic growth ex-SPAC, it's actually 49% year over year. So almost hitting that 50% year over year growth. But the trend speaks for itself. I mean, at one point 2 years ago, in Q2 of 2023, we only grew 13%. At this point, if you ask me, well, will Palantir grow at 50% in 2 years from now? Most people would probably say, nah, seems unlikely. But I mean, just look at this accelerating trend. It is very, very impressive. And why is it growing close to 50%? Well, the largest driver as of late is US commercial. US commercial grew 92% year over year, showing no signs of slowing. I mean, we had this 70% quarter back in Q4 of 2023, then it went down to 40, and we were like, okay, maybe this will, stabilize a bit around that 40% mark. Nope, hit 54% 2 quarters in a row. In Q4 of 2024, we hit 63%. Surely that would be the top. Nope, 70% last quarter and now 92%. And what's even more interesting, if we exclude SPAC revenue, US commercial actually grew 101% year over year. So over double in 1 year's time. That is, super, super impressive. And what I want you guys to keep in mind, so it grew 101% or, a bit less if you're not looking at organic growth. And overall revenues grew 48%. They did that while international commercial declined year over year. This is a chart of non-US commercial. So basically everything outside of the US on the commercial side. What do you see when you look at this chart? Not much of anything. It is bobbing up and down and nothing has happened for over 3 years. It is just staying stagnant. Sometimes it goes up a bit and then it declines 5%, goes up 2%, declines. Nothing is happening here. And imagine if we had US commercial growth looking like this, where it is growing 92%, but also international commercial growing as well, and not just, being dead weight. Imagine what kind of growth rates you would be seeing for Palantir. Now, US government, very, very strong. I've said it many times. I'm more bullish on the government side than the commercial side, kind of, at least for the next few years, because there's just so much of that budget that Palantir can capture. The total addressable market within government is just so expansive. And if we look here, Q4 of 2023, it grew 5%, more than doubled to 12. Next quarter, doubled again to 24, almost doubled again to 40, then to 45 for 2 quarters in a row, now 53%. I mean, this is just a very, very beautiful chart that just keep showing that exponential kind of growth. Super, super bullish in US government. Now, while international commercial is super weak and a dead weight, international government is actually growing. It is, not comparable to the US, but international government is actually growing a bit. 37% year over year. It grew 45% the quarter prior, but we know that there's been a lot of pushback, even with the NHS deal, that was a big one to kind of try to open up the international government markets a bit. We know Israel, we know Ukraine, like on the war front, but we had pushback in Germany when Palantir was deployed, across police force and stuff like that. Similar stuff happening in Denmark. So it has been a lot tougher for Palantir to grow internationally on the government side, but at least it is growing now. And hopefully a lot of those, I wouldn't say unwarranted, well, it is unwarranted, but unjustified fears that have been placed on Palantir due to media headlines and stuff like that, probably won't be a blocker for much longer. Just the sheer value that Palantir provides will make sure of that. And why am I so confident that Palantir keeps providing a lot of value to its clients? Well, if you look at where the growth came from, across all these segments, of the 48% year over year growth, 28% came from already existing clients. Only 20% came from new clients. And this shows you that companies that are already using Palantir are increasingly using it more and more and more. This chart speaks for itself. So we had AIP launch somewhere around here, Q1, Q2 of 2023. There was no real pricing strategy yet. The mission was to spread AIP probably at cost or, for free with some clients. But then it started to monetize. So you can see the start here of how much more each client spends with Palantir for each passing quarter. 7% was the bottom, 8, 11, 14, 18, 20, 24, 28. And what's stopping this from reaching 30%, similarly as we had in Q4 of 2021? Now, when you have close to 30% growth from, your existing clients, you don't really need a lot of growth from new clients to have some very, very impressive year-over-year growth numbers. And whenever people ask me like, well, how long can Palantir sustain these kind of growth rates? Well, when you're providing this much value, you are so sticky, and the companies, your partners, your customers are increasingly using you more and more because you're providing so much more value, so much more efficiency, so much more revenues, everything like that. Then yeah, it is very, very sustainable. And as we know from a UBS report from late last year, AIP is usage based. So I mean, the pricing is usage based. So if a company just uses AIP to solve one small use case, you won't be seeing a lot more revenue. But as they get more familiar with the product and start to deploy it across more use cases within their business, that has doubled or even tripled the revenue recognition from some clients that have really adopted AIP widely spread within their business. So the sustainability of the growth, I believe, is very, very strong, and we'll get into some contract balances in just a moment here. Overall commercial, combining international with US, for 47%, and overall government actually 49%. So from the two segments, commercial and government is actually driving the most growth. And that is simply because international commercial is not playing ball. And, just the trajectory of this chart, dating back to Q2 of 2019 is, the earliest quarter that we can get for the government segment. You can just see how beautifully it is starting to scale. We had this kind of stagnant period here, and now it's just scaling up and up and up. Similar stuff can be observed in the commercial chart. I think that's it for, you can look at this segmented revenue just to get, an alternative view where you can see each segment separated. And you can really see this green one is non-US commercial. And this bar is staying the same size, throughout all of these periods. Non-US government, international government, it is increasing slightly, but the real drivers, the real winners are the US segments. Let's move on to some contract balances. So let's first have a look at the deal breakdown. So new all-time high in net new deals. They signed 157 deals of at least 1 million. That doesn't mean that it's only 157 deals. It means that there are deals of at least 1 million. Of course, new all-time high in net new deals. Also new all-time high in deals closed of 1 to 5 million. Closed 91 of those. Deals closed 5 to 10 million. Not an all-time high, but close, 24. The all-time high is 26, so close. However, we have a new all-time high of deals closed of at least 10 million. And what that translates to is a total contract value per quarter. And as the name implies, it is how much the total contract value that they actually signed was during each quarter here. And that was $2.3 billion for this quarter. New all-time high there as well, grew 143% year over year. So in this quarter alone, they closed deals of $2.3 billion. So when you ask yourself, well, how much longer can Palantir grow? Well, I mean, the backlog is ever increasing. Similarly, if we look at remaining deal value, so how much is the total outstanding deal value that has not been recognized yet, it grew 65% to 7.1 billion. Now, important to keep in mind when we're looking at remaining deal value is that not all of these $7.1 billion are guaranteed, because it includes some options in the contract that are not guaranteed that they will be exercised. But including all contractual options, 7.1 billion outstanding. And as you can see, this has been growing very, very strongly, 65% year over year. I expect that to continue to increase. So yeah, Palantir has a lot of backlog to keep growing at a quick pace. We can even separate it specifically for US commercial. And this has been growing like weed. As we can see, prior to that AIP launch, US commercial was kind of stagnant, in terms of remaining deal value. AIP launched, bootcamps launched, and just look at this trajectory here. 145% year over year, up to $2.8 billion in US commercial remaining deal value. The quarter prior grew 127%. The quarter prior, 99%, and basically 100%. So 3 quarters in a row of just doubling year over year. Super, super impressive. We can even break out government and commercial total contract value per quarter. And as we can see, for this quarter in particular, 1.2 billion of the total contract value came from government, 1.1 from commercial. So actually government booked more contract value this quarter than commercial. People always call me crazy when I'm so bullish on the government side. I think a lot of people are sleeping on it. Government is gonna grow a lot, and it's going to be very, very strong and sticky. Of course, super, super bullish on commercial as well. I mean, the numbers we're seeing from US commercial is just, mind-boggling. But still, don't sleep on government. For this quarter in particular, actually, the last time government booked more than commercial was exactly a year ago in Q2 of 2024. Then, commercial has been dominating for 3 quarters, and now government back on top. But still, 2.3 billion, they're very strong. Remaining performance obligations. Now, as I mentioned, remaining deal value, this is not guaranteed. However, remaining performance obligations is guaranteed. But one thing to keep in mind here, so this is $2.42 billion this quarter, a new all-time high, up from, 1.9 billion last quarter, or a year ago it was 1.37 billion. So not quite a double, but still, a large increase. The thing though, even though this is all guaranteed future revenue, the problem is that this is more or less only commercial, because a lot of the government deals, due to the structure of the government contracts, all the optionalities, all the timings and stuff like that, they don't really qualify to be recorded as remaining performance obligations. So this is more or less a proxy on just the commercial side of the business, which is also, fine to have a good outlook. So yeah, $2.42 billion, a lot of revenue recognition to be had there. And as you can see, the trajectory is very clear. It's up and into the right. Similarly here, billings. So here we have a chart of, the quarterly revenue and the quarterly billings. Typically, when billings are higher than the recorded revenue, that usually tells a story that, upcoming quarters are likely to be strong. And when billings are lower, it could indicate that the upcoming quarters will be weak. Now, that's not, of course, a rule. But that's good to keep in mind. And as we can see, there's a big gap of $100 million here, where billings are a lot higher than revenues. So that also indicates that Q3 might be very, very strong. And as we can see, increased guidance and stuff, management seems confident as well. So with that in mind, all the contract balances, all of them are up and to the right, very, very positive, a lot of revenue recognition to be had. And then you combine it with this chart that talks about the cohort growth. And then you ask yourself, well, can Palantir sustain these growth rates? I mean, I think they can even increase the growth rates. I mean, it's just looking so strong. Some sales and growth efficiency numbers. Let's start with the rule of 40. Of course, Palantir has been bragging about their reported rule of 40, up to 94 now for this quarter, new all-time high. Of course, very, very impressive. But the way they record it is not the way that I prefer to look at the rule of 40. So they do adjusted operating margins as well as year-over-year revenue growth. Now, the reason I don't like it in particular is because it is just, one period being compared to one period. So what I like to do is I like to look at trailing 12 months. So basically, the last 4 quarters and combine that. That just, leaves out a lot of outliers in the quarters. Like some quarters might have a lot of interest revenue that won't be found in the next quarter. A lot of stuff can happen on a quarterly basis, but when you smoothen it out on a trailing 12-month basis, I think that makes a lot more sense for a company like Palantir personally. But I chart both just to have it. So what I do, instead of adjusted operating margins, I use a free cash flow to the firm on a trailing 12-month basis, and then I look at that margin, and then I use revenue growth on a trailing 12-month basis, and even there, a score of 87, super impressive. And you can see the rule of 40 basically measures the quality of growth. So some companies might, focus entirely on revenue growth and disregard profits. So they might grow 50% on a quarter, but if they're like operating or net income margins are like negative 50, they won't be able to combine those two to reach, 40. So combining growth rates with profit margins, if you can reach 40, that indicates, high quality kind of growth. And Palantir is 94. They've been jokingly saying for 3 quarters now that it should be renamed the rule of 80. And not a lot of people reach 80 on a rule of 40 basis. So super impressive, top of the line, super high quality business. Revenue per employee we can't look at because I don't have the new employee numbers. However, we can look at some customer acquisition costs and the time to payback. So more or less, and anything prior to 2023, we can kind of disregard because this was, boosted by the SPAC contracts. They basically invested in companies, and in return, those companies would become Palantir clients at, some exorbitant rates. So this is kind of, diluted. Like we shouldn't really judge these periods here, but starting from Q1 of 2023 is what we should be looking at. And if you look at the customer acquisition cost per customer, it is, the trend is very clear. It is down and into the right. So increasingly becoming cheaper for Palantir to acquire a customer. For this quarter, it was basically $2 million. And the payback time for that, customer acquisition on average is 4.9 months. So less than half a year, and the customer has paid for itself. So very strong. That is a new low. Of course, lower in months is better. So 4.9 months here, new all-time low. And the trajectory is very clear. Now, there are some seasonalities in this with, that's why you see some bumps in some quarters and some not. But the overall trend is down and into the right. So increasingly cheaper to get customers, and the customers are increasingly making more money, meaning that they are paying themselves off on a quicker and quicker basis. Let's go on to the customers. Total customers, of course, 80 net new additions. Not quite as high as Q4, which was 82, but still a large increase compared to these historical periods where we maybe increased by 24 customers, 30, in exceptional quarters, 44 new customers, 57. But we are entering a new kind of paradigm here where normalizing 80 would be great. If we can have a quarter of like 100 new customers, that would be insane. Total customer count is now up to 849, grew 43% year over year. And why are customers so important? Well, as we've been talking about, when you look at where the growth comes from, it comes from existing clients. So the more customers you get, the more your current customers scale their revenues, the more sustainability your growth has. So very important to keep growing that customer count. Government customers in particular grew 25%. And you might ask yourself, well, how many government customers can there be? If we look here from Q4 of 2020 to basically Q1 of 2022 for, a bit over a year here, it was kind of stuck at 90. Like they were not getting new agencies as customers. Sometimes some government agencies left, like here in Q2 of 2021, it went down to 88. Then it started growing a bit. but it is really limited. It is not like a commercial customer where you can just, flirt with any kind of business and then have them become your clients. Like government customers are much, much harder to increase. But still, 25% growth year over year, up to 157. So government customers growing beautifully. Commercial customers overall, up to 692, grew 48%. So an increase. We've been having this decreasing trend here from 55% in Q2, basically a year ago, Q2 of 2024. They grew 55%, then it went down to 51, 52, 46. At this 46%, a lot of investors starting to get a bit worried, like, why can't they, keep growing at a fast pace? We are expecting a lot of revenue. So, of course, customers have to follow. But yeah, back to increasing the growth rate. So 48% up from 46% year over year the quarter prior. Very, very strong there as well. And in particular, US commercial customers grew 64%. This quarter up to 485. So out of 692 commercial customers, 485 are from the US. Next up, profitability. Now, this is, the revenue growth rates, that's one thing. That is fantastic. Looks very, very beautiful. What makes it so special with Palantir is that their profitability is increasing very, very fast as well. Net income margins, 33%, 27% operating margins. Now, typically, a company focuses on revenue growth at the expense of profitability, or they focus on profitability at the expense of some revenue growth. Palantir has exploding revenue growth and exploding margins. And with some of the commentary during the quarterly report, these margins are likely to increase by a lot into the future. They're talking about decreasing their workforce using AI FTEs, forward deployed engineers instead of sending people, reducing cost of operations even further. I think I'm projecting them to easily surpass 40% operating margins within a few years. I mean, this is looking so strong. So basically, back in Q1 of 2023 was their first quarter of operational profitability, 1% margin. Basically, 2 years later, they grew from 1% to 27%. And as we know, the growth rates from, basically that Q2 low of 2023 has also been super, super explosive. And that's dynamic. When you can increase both your profitability rate and your revenue growth rate, create some magical moments in a company. And that is why I believe the stock price, just keeps going up and into the right, because that dynamic is just so attractive to investors. Now, you might ask yourself, well, why are the net income margins higher than the operating margins? Typically, it is the other way around, where, you have your operational expenses, you get your operating income, and then there are some other deductible line items, and then you get your net income. The reason is that Palantir still gets a lot of interest income. So they have a lot of cash, up now to 7 billion. I believe we will get to that chart in a second. But a lot of that is used to invest in US security, US treasury securities to get some yield. In other words, interest income. And as we can see here, even back in 2023, for 2 quarters here, basically almost all of the net income was from interest. And then over time, these black bars, have stayed kind of the same throughout all of the years here. 56 million was from interest, and 272 was, less interest income, just looking at the operating profits and, excluding interest income. And this has been, a pain point for a lot of investors. They're like, well, when the 10-year treasury rate yield goes down, Palantir is going to lose all their net income. Well, that's clearly not the case. As you can see, this golden part here is ever increasingly growing larger. Of course, Q4 is an outlier because they had very big SPC expense, a one-time SPC expense that lowered, the net income by a lot. But outside from that, they are growing their net income a lot. And that is, of course, due to their operational profitability increasing so much. But for now, net income will be slightly higher than the operating margin due to that interest income. And it makes sense if you're not cash constrained to grow, where should you put your cash? Like, should you just burn it up in hopes of, increasing revenue growth by 1%? Like, it makes no sense. So the prudent thing to do is make use of the high treasury yield. Place your cash there. I mean, up to 7 billion now. Farm that yield while you can. And then once the yield is not as attractive, then we can start to think about, okay, what should we do with all this cash? Because keep in mind, Palantir has no debt. They have no debt. And they are generating cash at a very fast pace. So if we look at adjusted free cash flow margins here, 57%, this is very seasonal. When you look at our quarter to quarter, you can see a lot of bumps up and down. And that is because when they recognize cash from their contracts, it's typically geared towards the latter half of a year. So that's why you see this kind of seasonality. If you look at it annually, it makes a lot more sense that this is just, increasing more steadily than what the quarterly chart showcases. But still, 57% margin, very strong. If we look at the free cash flow to the firm margins as well, side by side, we can see that the free cash flow to the firm margins are very strong as well. Now, you might ask yourself, well, what is the difference between the free cash flow margin and the free cash flow to the firm margin? And the difference is that free cash flow typically is defined as cash from operations minus capex, and then you get your free cash flow. Free cash flow to the firm actually looks at all reinvestment needs to the business. It looks at the change in net working capital. What did I say? Looks at the changing in the net change in working capital is what I meant to say. Sorry, I don't know what I said. So basically, it takes all the reinvestment needs into account, which is also what you use when you create intrinsic valuation models typically. So free cash flow to the free cash flow normally is just a shortcut kind of, to get a quick overview, while free cash flow to the firm looks at the reinvestment needs as well. And that is up to 50%, very strong. What else? I don't really care about EPS, but we can look at that as well, up to 0.13 for the quarter. Also, the trajectory is clear, similar to net income, of course, where it just keeps increasing. I don't care too much about EPS. Yeah, so another chart that might be interesting to see here is like, okay, well, what are the operating costs and what's happening to them? So there's a clear trend here. So we have the operating costs, can be divided into R&D, which is the yellow line at the bottom here. Surprisingly, even a super high-tech company like Palantir, R&D is like their lowest operating cost. The highest one is actually sales and marketing, now down to 24% of revenues in Q2 of 2025. R&D is 13%, so almost half of the sales and marketing expense compared against the revenues. And then we have general and admin at 16%. But as you can see, the revenue far outpaces the operating costs, which is why the operating margins keep increasing. And if you look at the absolute numbers and not in relation to revenues, they are kind of stagnant for the most part. Like, they are not increasing by a lot, and some quarters they even decrease. So there's a lot of operational leverage built into Palantir. So that will be interesting to track. Moving on to some miscellaneous charts. SPAC returns, it's been a long journey. 4 years later, we are finally break even on the SPAC invested amount. So in total, they invested $450 cumulatively now from the revenues, from selling out of the positions that they had. They are now up to 449. So basically rounded, that is 0%. So finally, they got their cash back from SPACs. Of course, SPACs weren't purely to try to make a profit from, making investments. SPACs also, they were really diversified into different industries and different kind of businesses. So they got a lot of R&D from the front lines, a lot of exposure to different industries. So the SPACs made sense in that regard, but also now on an cumulative basis, they are now break even. So fun little fact, but I know a lot more people care about SPC. Stock-based compensation is down now to 15.9% of revenues. Now, keep in mind that the average in the SaaS space is around 23, 24%, depending on the peer group you look at. Palantir, always been hated on for, being so dilutive that they have so high SPC. But, for the past 2 years, they've been like below the SaaS average. They are not, excessively diluting compared to the industry. In fact, they are, as of this quarter, they are like kind of far below the average. Like they are like one of the top companies of, least dilutive companies. Like the only ones that have less SPC as a percentage of revenues are like the legacy kind of companies, like, like an Oracle or Salesforce are kind of low, these old, kind of legacy businesses. But any modern SaaS is a lot higher. So 15.9%, and more importantly, the trend is decreasing. Of course, Q4, as I mentioned, had a one-time SARS expense, which, increased this by a lot. But overall, the trend is down and into the right, which is what you want to see as a shareholder. Net cash, as I mentioned, now up. Oh, I said 7 billion. It is 6 billion. My bad. So this is cash and short-term investments combined. Outstanding shares increased by 6% year over year. Maybe let me add some decimals. Let's add one decimal here. 6.1% year over year. Similarly here, it is decreasing over time. As they went public, of course, you had this big increase, but then, they've been very dilutive historically. Like a year ago, diluted by 12.2% year over year. Stuff like that. It is going down. It is still kind of high, but the overall trend is down. What else? I can't look at institutional ownership yet. The 13F filings are not completely out yet, but still surprising that for 3 quarters in a row, it's been stuck at 49%. Maybe now finally in Q2, institutions will own more than half of Palantir. It's going to be interesting to track here if they can increase their overall percent of shares held. I kind of suspect them to do that, even though Palantir has been trading so high. But yeah, kind of curious that for 3 quarters in a row here, stuck at 49%. And similarly, the 3 quarters prior to that, it was stuck at 41%. So I don't know. It seems to be like 3 quarters and then jump up, 3 quarters and then jump up. So let's see what happens as we get those 13F filings. With that, how long have we been going? 40 minutes, man. I've been speed running these, So yeah, the overall most bullish chart to keep in mind is the cohort growth. How much of the growth is coming from existing customers? Because that tells you everything you need about how valuable the software actually is. Carp keeps saying that we are the best software company. We're gonna dominate, but the numbers have to back that. And the numbers are saying that people who are using Palantir, like they are not it's not like they are, you know, fooling new customers into paying a lot for Palantir. No, this, like, the growth is mainly coming from existing clients that know what they're getting from Palantir and they simply want more of it. So that dynamic, together with the overall customer count growth, is what will drive Palantir into the future. Like, the scalability is off the charts, together with, of course, the ever increasing operating margins, which then of course translates into free cash flow margins as well. So with that said, I think we covered everything so far. So for those of you that have purchased the Excel sheet over at typeofcapital.com for Palantir and Robinhood, you can expect updates soon. Perhaps you even got the bundle. You will be, you know, receiving an update soon. Or if you are a member of the Substack, you can find the new valuation here under intrinsic valuation. So please subscribe if you haven't already. I also just recently dropped a whole new PayPal equity research piece. You know, can find a lot of stuff on the Substack. So have a look. Thank you so much, guys, for the support, and I will see you guys in the next one. Fantastic quarter.